On Monday, April 7th, 2026, global markets swung violently out of control as an 8 p.m. war deadline loomed over the Middle East. This map shows the exact geographic flashpoint driving the panic, the Strait of Hormuz. In anticipation of a conflict, civilian human chains began forming around Iranian power plants. The threat of a closed choke point meant immediate economic fallout. Traders priced in the worst-case scenario, pushing crude oil past the critical $112 per barrel threshold in a matter of hours. For the everyday investor watching red ink flood their screens, the psychological toll was suffocating. The instinct to hit the sell button, liquidate portfolios, and retreat entirely to cash was nearly impossible to ignore. But surrendering to Monday's terror meant locking in those losses right before one of the most explosive, counterintuitive market rallies of the year. How did sentiment flip so drastically in just 48 hours? The turning point arrived Tuesday. U.S. strikes hit Karg Island, but they were highly strategic. As you can see by the active burning flares in this photo, the operation deliberately spared critical energy infrastructure. That precision allowed for a rapid diplomatic thaw. Back-channel negotiations quickly produced a 10-point proposal, which was cemented by an official ceasefire announcement posted directly to Truth Social. This line chart captures Wednesday's violent upward reversal. As blockade threats evaporated, global indices ripped higher, with the Nikkei surging 5.39%. We can track exactly where relief capital flowed. Heavily punished travel stocks exploded, with United Airlines and Carnival Cruise seeing double-digit breakouts. Simultaneously, the geopolitical premium on energy vanished. Crude oil capitulated, dumping back toward $98 per barrel. This sudden surge was predicated entirely on the week's headlines. While prices climbed, the underlying macroeconomic environment, the data that actually sustains a bull market, had not yet made its voice heard. The celebration was cut short on Friday morning when foundational U.S. economic data hit the wire. This scale visualizes conflicting signals. The economy added 178,000 jobs, with unemployment at 4.3%, offset by sluggish hourly earnings. Then the fatal blow. A CPI report showing surging energy costs sent consumer sentiment plummeting to 47.6, completely crushing the positive labor numbers. And despite the celebrated political ceasefire earlier in the week, the physical root cause of the supply chain crisis, the Strait of Hormuz closure, remained technically unresolved. The week's wild whipsaw delivered a clear lesson. A short-term geopolitical relief rally cannot magically erase entrenched long-term inflation. The stock market acts as an emotional pendulum, reacting to daily headlines, but eventually it always anchors back to underlying business fundamentals. Warren Buffett's mandate to be greedy when others are fearful provides a mathematical framework for surviving this level of volatility. The businesses that survive these panics share one singular trait: pricing power. This is the rare ability to raise prices to combat inflation without losing your core customers. This chart demonstrates that resilience. TSMC's massive 35% surge in AI revenue completely insulated its balance sheet from geopolitical panic. But you must demand a strict margin of safety, waiting until headline panic artificially discounts the stock below its stable intrinsic value. That's why we use the long-run score. It serves as an objective, emotionless tool designed specifically to identify these high-quality compounders when peak market fear makes them cheap. True wealth isn't built by predicting tomorrow's headlines. It is built by having the discipline to buy quality assets at a steep discount, exactly when the rest of the world is desperately trying to sell.